Hi, we're here today to talk about the introduction of corporate tax in the UAE and how it may impact M&A deals in the region. My name's Anna Robinson. I'm a senior associate in our corporate commercial team in Dubai. And with me, I have colleagues from our tax team and our corporate commercial team who I'll let introduce themselves.
My name is Shiraz Khan. I'm the head of the tax practice at Al-Tamimi & Company across the Middle East region.
My name is Suhail Mirza. I'm a corporate partner in the M&A team of Al-Tamimi. I specialise in tech and infrastructure M&A across the GCC region.
So I think probably the first question to kick off with is how important is tax when it comes to M&A transactions in the region?
I think it's critical in terms of taking into account the tax implications. I think there's been a historical misconception that tax is very limited in the region, and that's largely been fueled by the tax light environment in the UAE. So with no federal corporate tax historically, with only tax at the Emirates level, historically there being no indirect taxes, a lot of people and businesses think and investors think investing into the region doesn't have any tax implications. But of course there's been a lot of tax reform in recent years with the introduction of indirect taxes. Contrary to popular perception, many GCC countries have had corporate tax since the 1950s. For example, Saudi Arabia, Oman, Qatar and Kuwait. And also, there's been a lot of focus on corporate tax more recently with the introduction of corporate tax in the UAE as well, very recently. So tax is becoming very, very important. It's also important to understand the difference between taxes in mature jurisdictions and the region. So in the mature jurisdictions, there's very prescriptive legislation, which is very detailed, and the legislation is supported by a wealth of case law. In this region, the legislation is very, very brief. So in the UK, for example, the tax code is 20,000 pages. In the region, typically tax legislation is 60 pages. So it's very, very brief, but the complexity arises through the simplicity. There's very limited precedent, and so there's a lot of uncertainty in terms of the application and interpretation of the legislation. And going forward, tax is going to be a major business cost, so it's important to look at the tax implications of a transaction, and also it's important for the purchaser, whenever they're making a transaction, to effectively do a due diligence to understand the tax risks and the hidden tax exposures and the liabilities, and also to get protected through the indemnities or warranties.
Suhail, would you agree or have anything extra you'd want to add?
Yeah, sure. I mean, I think essentially with tax, it's about allocation of risk. And as Shiraz mentioned, you've got the question mark over a warranty versus an indemnity. So indemnities will typically cover all tax liabilities up to the period of completion, whereas warranties, from my experience, are used more as kind of an exercise to verify and back up due diligence. So with warranties, you usually solicit information around tax compliance, recording and reporting obligations to the FTA, that sort of thing. So warranties give you that kind of contractual protection, but I think there's going to be a stronger emphasis in terms of regional deal making and negotiation around tax indemnification to deal with UAE corporation tax. And it's not a novel concept. Like Shiraz mentioned, corporation tax has been on the table across the GCC, particularly in some of the other jurisdictions. It's relatively novel to the UAE in the sense that it came into effect on the 1st of June 2023. But even prior to that, we've been grappling with VAT, which came in not so long ago, and then customs duties and excise, which are all relevant on M&A transactions. So we're not new to tax per se. It's just that now there is a greater focus on corporation tax and compliance as far as UAE companies are concerned. So that's where the due diligence becomes more relevant, and the negotiations around the allocation of risk around tax liability is relevant to deal making.
And have you seen any sort of effect on the deal making climate in the UAE, particularly focused on this introduction of corporate tax?
Yeah, I mean, from my experience, I actually felt like in the period from the 1st of January, coincidentally, I joined Al-Tamimi on the 16th of January, so I'm still relatively new. But I actually found that there was pretty much a wait and see from clients on the M&A side. So with a view to tax being implemented on the 1st of June 2023, a lot of buyers were we're looking at the climate. I mean, for example, if you look at EBITDA, which is a typical mechanism to value a business, the T in EBITDA stands for tax. And when you don't have substantive corporation tax for a UAE target company, then the T isn't as relevant. But now, obviously, with corporation tax in play and valuation mechanisms having to look and focus at tax as a key issue, I think a lot of people just waited to see what would happen with the implementation of corporation tax. And as Shiraz alluded to, a lot of the legislation in the UAE comes in the form of executive regulations. So we expect to see, and I'm sure Shiraz will confirm this, we expect to see more regulations to clarify how corporation tax is going to be implemented in detail. And therefore, I think that created what I call a wait and see environment. But now that we've kind of got through the 1st of June 2023, personally, my deal pipeline, and as you know, Anna, our deal pipeline is very healthy. We're still seeing deals in healthcare, schools, infrastructure. So the market, the GCC market is buoyant, and obviously we've got a lot of work in KSA as well. So I don't think tax has had that sort of seismic change in the GCC M&A market. It's still a very buoyant GCC M&A market, and our workload and our pipeline will testify to that.
I just had a few comments on that as well. So, of course, up until now, when it comes to M&A transactions, only VAT was relevant. Going forward, corporate tax will also be relevant, and corporate tax is significantly more complex than VAT. So going forward, if there's a major cost in terms of corporate tax, that will need to be taken into account by the buyer. And also in terms of profitability of the business in the future, that will also be impacted by corporate tax. So that's something that needs to be considered. That said, I mean, the corporate tax rate is 9%, so it's fairly competitive. If you look across the region, Saudi Arabia has 20%, Oman and Kuwait have 15%, and Qatar has 10%. So it is the lowest rate in the region. And therefore, I don't really expect a major impact on the deal activity. Of course, investors will need to look at the corporate tax implications and also the costs in terms of doing transactions in the future. But I don't think it will have a major impact on the actual transaction flow.
And most of our discussion has been around the impact that it's going to have on the buyers or the investors. Have you got any thoughts about how it may impact the sellers?
Yeah. Again, I think it goes back to due diligence, and obviously sellers need to have a target business that is ready for the market and is attractive to buyers. I think, I mean, from my experience over the recent years, we've seen an increasing burden on regulation in the region, and I'm not just talking about tax. If you look at economic substance requirements, that's been in place for a few years now. But now with tax, we have more reporting obligations, and this is where compliance with tax reporting interfaces with issues such as your IT systems and your internal financial management processes. So from a seller's perspective, acute seller grooming a business for the M&A market would need to be sure that they have in place internal systems and processes that are compliant with the tax regulations, so that there is a reporting system which complies with the federal tax authority's requirements on a periodic basis, so that when it comes to undertaking due diligence on that company, if we're acting as buyer's counsel, can confirm that the company is in good standing, as it were, for that purpose. So that is very relevant to sellers. I think there's also an element, and I'm sure Shiraz can jump in as well, scope for pre-sale reorganisations, given that there is a distinction between operating income outside of the free zones, and I think you can probably verify the distinction, and also trying to identify some tax efficient structures. And we've always seen holding companies in the UAE within the financial free zones, the IFC or ADGM, but I think there's now probably more scope to look at a group structure holistically and try to identify where there may be some tax synergies to shifting operations from mainland into free zone, or vice versa, as the case may be. But that's probably something, Shiraz, you can explain.
Sure. I think from a seller's perspective, clearly it's going to add more complexity to the transaction because more work needs to be done. Now, due diligence will also need to be done on corporate tax, which I said is significantly more complex. And it will also make the negotiation a little bit more complex. So that's something the seller needs to take into account. In terms of pre-sale restructuring, of course, there are opportunities to ensure that the transaction is structured in a tax-efficient manner. So some of the things which need to be considered are, for example, do you want an asset deal or do you want a share deal? And each of them has to be analysed very carefully because they have different tax implications. Also, in relation to certain internal restructuring, there may be some group reliefs available in terms of internal reorganizations. So they need to consider whether this relief is available. Also, in terms of availability of tax losses and certain tax attributes. So in the case of a share transaction, the losses may be preserved, whereas in the case of an asset deal, you may lose significant tax attributes like losses. So all of this really needs to be taken into account in determining the tax efficiency.
Suhail, you touched briefly earlier on the difference between a tax covenant or tax indemnity and tax warranties. Could you go into a bit more detail as to what the difference is and what exactly we'd expect to see in a tax covenant now that the UAE is a more complicated tax jurisdiction?
Yeah, sure. I mean, again, the question is really around the allocation of risk, and I think the conventional theory in most M&A markets is that any tax liability arising in the period prior to completion should be borne by the seller. And therefore, with an indemnity, some people call it a deed of tax covenant, but essentially it's an indemnity where basically the seller is obliged to reimburse or indemnify the buyer on a dirham for dirham basis for any tax liabilities arising in the period prior to completion. Compare that to warranty. A warranty is a generic contractual statement which is set out in the SPA, the sale and purchase agreement, which usually attaches with it certain limitations in terms of de minimis, in terms of making a claim, a maximum amount which may be claimed, and also a limitation on the time frame in which you can make a warranty claim. Typically can be as short as 12 months and can be as long as 36 months. So warranties are not as beneficial to the buyer when compared to a tax indemnity. So I'll see what we're seeing is having a tax indemnity is a fairly standard provision now, which will cover liabilities under corporation tax and all other taxes in the period prior to completion. So that's where the market's probably changed, but it's consistent with what we would see outside of the UAE, where there is more mature tax legislation and tax experience.
And how do you find having a tax covenant or tax indemnity interacts with pricing mechanisms? You already mentioned that EBITDA is now going to be more important. Or what about completion accounts or permitted leakage? How does that interact with having a tax indemnity?
Well, tax indemnity is just it covers all losses, all tax liabilities arising in the period prior to completion. I think completion statements and EBITDA statements are kind of a mechanism for valuing a business are still going to stay. I think what's probably going to be more important is to have your tax advisors working with you in terms of agreeing what the accounting principles are. For example, has there been a reserve made for tax in the accounts? Has the buyer understood that tax has already been allocated in the completion statement? So from a corporate law's perspective, I think it's more important to have tax advisors working in parallel to agree those completion statement mechanisms and the way EBITDA is calculated. I think that's what's going to change. There's more of an emphasis on working with your tax counsel to get the documentation correct.
Yeah, as Suhail said, a tax indemnity is different from a warranty. Of course, both are important protections for the purchaser, but in terms of an indemnity, it gives you dollar for dollar basis protection, whereas in the case of a warranty, quite often there's additional hurdles. It's not simply a case of the event occurring and you get reimbursed on a dollar by dollar basis. So you also have to prove, in the case of a warranty, you have to prove breach, you have to prove the loss, you have to prove that the breach caused the loss. There's certain steps that you have to take to mitigate the loss as a purchaser, and also the loss must not be remote. So definitely indemnity is a preferred mechanism, but indemnity often only indemnifies you for pre-completion liabilities which crystallize post-completion. So to the extent it's not covered by the indemnity, a warranty is helpful. And also, as Suhail said, a warranty is also useful, elicits and facilitates disclosures from the seller. So it helps you understand the tax risks and obtain more information on the tax position of the target group.
Well, I think that sums up our discussion today. If anybody listening or watching wants to get in contact to discuss any of this any further or to seek any legal advice, then please do reach out to us.